All right, well, hi there, everybody, and welcome to the Investment Review Committee Income Share Class Update for March 2018. As always, this is Jason Ayers here, and I'm happy to welcome Mark McAdam, Lead Manager for our Income Share Class Fund. Mark, how are you today?
Excellent, thank you.
Good, good. So let's jump right in and take a look. Of course, these are returns as of February 28th. So let's take a look at how we fared for the month of February and move on from there.
All right, so we were down a little bit lower than the overall index. We're down 0.81%. The overall index was down 0.66. The result is just more the type of duration that we have in some of our securities. Our bond portion is lower duration, but we also have some real estate and some utilities and some high yielding securities that do have an embedded duration. So they pull back ever so slightly, but year-to-date figures, we are still beating the index. The index is down 1.5, we're only down 1.2. So just kind of steady as she goes. There's no concerns. I'm happy with the overall holdings. Now, just looking at the sectors that we're overweighting and underweighting compared to the TSX is that we still have underweightings in the telecommunications and materials. We just don't like the overall risk. And also the energy, we have underweighting as well. We are overweighted healthcare, utilities, information technologies, and industrials, and real estate slash financials. The valuations are just a little bit more compelling, and the risk metrics are a little bit lower. So that's why we're already weighting those particular sectors. So we had a little bit of a bumpy beginning of the February. We had a large market sell-off as a result of inflation figures that were higher than anticipated. So that caused a large market sell-off. So what we did to structure the portfolio to benefit from this sell-off is that we sold a large portion of the preferred income, and we actually put that into a large allocation of covered calls. So there you see a significant shift of the preferred income dropping probably about 10%, and also a large jump in the equities. We also have put into it's not showing up on the slide, but just in the late beginning of March, my apologies, is that we started employing some hedges because we are taking a little bit more aggressive stance, but we want to put a hedge just to stomach any significant pullback. So we have the benefits of the covered calls with the equities, and we also have the additional benefits of the long puts that we bought. We actually bought puts all the way up to 2020 on the SPY. So that's what we did. We did some significant selling and buying within the pool for the month of February.
Yeah, so basically just took advantage of the significant drop, took action on a number of companies that were very attractive, and there's the result of the transition over to more heavily weighted in equities. But again, just to clarify, beginning of March, looking at the U.S. exposures in the portfolio and subsequently building out a long-term hedge using S&P put options to help offset some of the volatility. Perfect. So one more slide we want to tackle here, just a comment on sector allocation, I guess, change on a month-to-month basis.
Okay, so we are going to be overweighting the financials, the information technologies, and the industrial sectors. With interest rates going up, that financials will generally have higher margins. With the large market sell-off, some specific sectors of the information technology area are fairly valued, and when you throw the option on top of it, that you have an additional layer of safety, and we have reduced some of our utilities and healthcare plays. So we're just more shifting the portfolio to more of a growth area because VIX is very high, so therefore it gives us a certain degree of hedging, so we can be a little bit more aggressive. We took some money off the table off discretionaries and consumer staples and energy, so we're just going to more of a strategic plays on some key sectors that we see value and also we see growth.
So I think that's the important consideration. It's just a lot of active management during these volatile markets to take advantage of the opportunities on a day-to-day basis. So fantastic, Mark. Always good to get your insight. And so I appreciate your time. And thanks very much for everybody joining in.